Hello everyone, Alex Kim here. What we observed during the intraday session was a synchronized surge across mining equities that carries clear institutional fingerprints. These stocks moved higher simultaneously without any news catalyst driving the action, which tells you that capital was being deployed in size and with coordination. There was a brief pullback after the initial move, then a gradual grind higher into fresh highs, and by the close we had substantial gains across the mining sector. What stands out is that mining stocks led the metals themselves. Gold and silver were barely moving earlier in the day when the gold and silver stocks were already showing significant strength. This is not a retail story. When you see this kind of divergence, where the equities are advancing while the underlying commodities remain flat, you're typically looking at early-stage positioning ahead of a broader move in the physical market. The physical silver market is showing signs of structural tightness that are becoming increasingly difficult to ignore. Physical demand is accelerating while available inventory contracts, and the risk of outright shortages is building. There simply won't be enough product to meet demand if this trajectory continues. Demand for physical precious metals has been relatively muted over the last few years because the broader market didn't recognize the structural changes that were developing beneath the surface. Now we're at a point where those dynamics are becoming visible, and we could see another substantial move in the metals in the coming sessions, potentially including a significant gap higher after the weekend when liquidity thins and positioning adjusts. This isn't speculation. This is positioning. Gold is currently trading near $4,020, which puts it less than $100 below the $5,000 level. We're still in January and gold is already in record territory. Silver has crossed $96, posting a gain of more than $3 on the day, which represents one of its strongest single-day moves in recent memory. The forecast that silver would reach $100 this year was made previously, but the expectation was not that it would happen in January. Yet here we are, and that milestone appears likely to be reached within the month. The catalyst driving this surge is multifaceted, but centers on broad-based weakness in the US dollar and a flight of capital out of dollar-denominated assets into gold and silver. Institutions are finally recognizing the significance of what's unfolding and are reassessing how cheap gold and silver mining stocks are relative to the underlying commodities. That's why you're seeing such aggressive buying today, and why gains of 5 to 10% or more are appearing across the board in the mining sector. These stocks are pretty much all at new multi-year highs at this point. The catalyst that appears to have accelerated this move was Donald Trump's speech at Davos yesterday and the announcements that followed. There was also a press conference the day before to mark his first year in office, but the bigger event on the world stage was the Davos speech. That event appears to have reinforced expectations around policy shifts, currency debasement, and changing global capital flows, all of which are feeding into the current move. Gold's breakout phase began in 2024. That was the first year of this broader move for gold. Silver followed in 2025, which marked the first year of its breakout. We are early in this cycle. There are years ahead of us in this move, and the current gains represent only a fraction of what's likely to come. Mining stocks are just now entering their own breakout phase, and 2026 appears to be the year when they finally accelerate in earnest. Even though mining stocks had a strong year in 2025, with some silver-focused names tripling and broader mining stocks at least doubling, their earnings grew even faster than their stock prices. That means they ended the year cheaper on a valuation basis than they began, which is a rare setup. This suggests that 2026 is the year when these stocks will see their most significant gains. We're early in what could be the best January the sector has ever had, and 2026 may turn out to be the best year the sector has ever had, following what was already the best year on record in 2025. This is not the end of a trend. This is the beginning. The US outperformed global markets from 2011 to 2024. That was a long run of American exceptionalism in the markets. That streak is over. Many investors are still operating with a rearview mirror mentality. They don't yet understand what has changed and how that shift is going to impact their investment returns going forward. The framework that worked for more than a decade is no longer operative, and those who fail to adjust are going to miss a significant portion of this move. The argument being made is that you need to get out of the dollar because once the dollar's purchasing power is eroded, it's gone. If all you hold are dollars, you're left with nothing of real value. This applies not only to those holding cash, but also to those holding cryptocurrency. Bitcoin is still trading around $89,000, which may give holders a false sense of security. The warning is that when Bitcoin begins to decline, it will do so rapidly, and if you're not already positioned out of it, you may not have the opportunity to exit. The best time to exit, according to this view, is right now. If you find this breakdown useful, consider subscribing to the channel so you don't miss how these signals evolve. Returning to the intraday action, what we witnessed was major institutional capital flowing into mining stocks across the board. The public narrative lags the positioning. They all surged at the same time without any headline-driven news, which suggests a bunch of money came in systematically. There was a pullback, then a gradual climb to new highs, and the result was substantial gains in the mining stocks that led the metals. The metals themselves were barely up earlier in the day when the gold and silver stocks were already showing strength. Gold has surged into territory it has never been in before, trading near $4,920 and sitting less than $100 away from the psychologically critical $5,000 level. Silver has exploded above $96 with one of its strongest single-day moves in years. This isn't the end of a cycle. This is the beginning of a historic breakout across precious metals and mining stocks. The recent surge has been fueled by a sharp decline in the US dollar and a decisive shift in institutional behavior. Capital is rotating out of dollar-denominated assets and into gold, silver, and especially mining equities, which many institutions now recognize as deeply undervalued relative to where the commodities themselves are trading. Mining stocks are posting widespread gains of 5 to 10% or more, with many hitting fresh multi-year highs even while metals were flat earlier in the session. That's an important signal that stocks are leading the move, which historically appears near the early stages of major rallies in the metals complex. The catalyst accelerating this trend was recent global commentary from Donald Trump at Davos, which reinforced expectations of policy shifts, currency debasement, and changing global capital flows. Gold's breakout began in 2024, silver followed in 2025, and mining stocks appear poised for their true acceleration phase in 2026. This marks a major turning point as U.S. market dominance, which persisted from 2011 through 2024, begins to fade and global assets start to take the lead. Investors who are still clinging to dollars, traditional equities, or crypto may be dangerously behind the curve at this point. Watch the flow, not the headlines. This move is going to accelerate as the dollar really starts to weaken. If Trump's primary objective is a higher stock market, he may achieve that, but it will be driven entirely by a weaker currency rather than genuine economic expansion. Higher stock prices become irrelevant when grocery prices are rising faster. When you go to the supermarket, prices are climbing more rapidly than they are in the stock market. The problem for many Americans is that they only go to the supermarket. They're not in the stock market. A significant portion of the population doesn't own stocks at all, which means they don't even get to offset some of what they lose at the grocery store with gains in the market. Their wages are being eroded. Whatever savings they have are being eroded by inflation, and they have no hedge against it. Silver ETFs are up approximately 3.76%, which reflects a bit of profit-taking from intraday traders. But the expectation is that they'll return with strength, and that tomorrow we'll see another significant move higher. The GDX, which tracks larger gold miners, is up 3.83%, just under 4%. The GDXJ, which covers junior miners, is up about 5.5% after touching a high of around 6% intraday. We didn't make new highs into the close, which suggests there was some profit taking, but these are still new multi-year highs for these indexes. In fact, the GDX is at a record high. This is the highest it has ever been. The GDXJ, on the other hand, is still below its 2011 high by about 20%. Gold is more than double what it was back then. It was below $2,000 in 2011, and now it's approaching $5,000. But those junior mining stocks are still lower than they were at that prior peak. That valuation disconnect is not going to persist for long. The expectation is that those 2011 highs will be taken out by February, if not before the end of January. And then the move extends much higher from there because we're entering a fundamentally different world. We are moving back to a world where the US dollar is not the center of the global financial system. It's not going to be a world where everything revolves around the United States the way it has for the past several decades. The US has been able to consume what everybody else produced. The US has been able to borrow what everybody else saved. And to that degree, the US has been a critical part of how the global economy functions. But that framework is changing. Institutions don't chase price. They manage exposure. As the US dollar continues to weaken, the acceleration in gold, silver, and mining stocks is becoming impossible to ignore. Rising stock prices may look impressive on paper, but they are increasingly meaningless when inflation is destroying purchasing power faster than wages or market gains can keep up. For millions of Americans who don't even own stocks, the reality is brutal. Grocery bills climb relentlessly, while savings and incomes are quietly erased by inflation. This is why capital is flooding into hard assets. Silver ETFs are surging, gold miners are breaking into record territory, and junior mining stocks are posting multi-year highs. What's most striking is how cheap these stocks still are compared to where gold and silver trade today. Gold is more than double its 2011 level, yet many mining equities remain far below their historic highs. That disconnect won't last much longer. Profit-taking may cause brief pauses, but the broader trend is clear. The world is shifting away from dollar dominance, and the US is no longer the center of the financial universe it once was. The era of borrowing what others save and consuming what others produce is ending, and markets are starting to price that transition in. Silver doesn't move first, stress does. This move is still early, and what comes next could redefine global investing for years to come. The question is not whether this continues, but how quickly the repricing occurs, and how wide the gap becomes between those who repositioned early and those who stayed anchored to the old framework. If you want to stay focused on what actually drives the silver market, subscribe and leave a comment with what you're watching next.